Well, good morning, everyone. Welcome to our Wednesday morning trading room. My name is Eric Senft. I'm going to be your host here for the next hour and a half or so. For those of you new to our trading room, welcome. The markets have just opened up. I'm going to give you a really quick overview of what you're looking at here. This is the DTS system. It stands for Diversified Trading System. And it's diversified because we're looking at the market from three different points of view. Here in the top left, we have the Hawk Micro Scalper. Top right is the Falcon Swing Trader. Bottom left is the Eagle Trend Trader. And the bottom right is the latest addition to the DTS family. This is the Raptor. Now, the Raptor actually incorporates elements of all three birds into one trading tool. We had a lot of owners who were trading off of laptops and whatnot and said, can you give me a one screen tool? And that was kind of the impetus behind developing the Raptor. The markets you're looking at here are the NASDAQ. I'm also following gold and crude oil, but this is your room. So if there's any market you would like me to pull up and show you what it looks like, please, by all means, ask away. I'm sure there's probably at least one or two E-mini traders in the room, maybe even somebody who wants to see some of the currencies. So just let me know. You can type your questions into the chat window there. All right, Maurice says he only trades the crude oil market, so let's take a look at crude oil. Actually, what I'll do is I'll change it on this one. I have crude oil on my other monitor, but we haven't gotten into any trades yet, so let's take a look at crude here on this monitor. All right, so crude oil's been trading about a half an hour already. It opened up at 6 o'clock my time, 9 o'clock Eastern. I'm on the West Coast here. These blue dots that you see here, by the way, these are part of the trade manager. We'll get to the trade manager here in a little bit. These dots essentially show where the trade manager would have our stop strategy if we had a live trade going on. So here's crude oil now on the Hawk Scalper, and you can tell from all these yellow bars mean the market is neutral, that we have a market that's pretty much stuck in a sideways range at the moment. There's nothing really tradable going on here at this time. People are always asking me, Eric, how do you trade a choppy market? Well, the best way to trade a choppy market, I think, is just to flat out identify that the market is in chop and then either avoid it until it gets outside of this choppiness, or if you're really ambitious, you can try to buy the bottom end of the trading range and sell the top end of the trading range. But generally speaking, what we like to do is we just like to let it get outside of here, retest the breakout, and then look for our buy signal, which will develop. And same thing here to the downside. Let it get outside of this range and let the market print a signal for us. Let the tool print a signal. Now we do have, if you're really anxious to take a crude oil trade, the Hawk is flashing a green bar sell. Now we haven't, well, I guess we might consider this move here a retest of the lows. But if you were looking for another retest of the lows, you could short this green bar sell. This is a counter trend signal, or pardon me, a with trend signal on the Hawk, but it's also one of our weaker signals. So I'm not too anxious to get into that one just yet. Oh, I should point out that all the signals develop the same way. When we first get the parameters of a trade, let me find you a decent signal here to show this on. When we first get all the trade parameters, we get a warning dot and an audio alert. So if you're watching multiple markets, that audio alert allows you to go, check out whatever market might be producing the signal. When the trade parameters are met, we get a triangle and a hash mark. That tells us that all the trade parameters have been met and now it's decision time. Now the hash mark is only a suggested entry. And you can see, if we produced a signal up here, so we got the warning dot triangle hash mark, I don't have to enter right on the hash mark. With the swing high just a few ticks away, I might choose to enter above there instead, rather than right on the hash mark. Now I should also point out, and I'll be quick about this because I know those of you who have been in the room before are familiar with this concept, but where did I put it? There it is. We don't necessarily take every single signal. We look for our high probability setups, and you can see this is what they look like here. So with the Hawk Scalper, for instance, we're looking for things like the first micro-macro cross signal. We're looking for the macro pullback signal, the 4-arrow consolidation, the post 4-arrow consolidation, and the red bar buy or the green bar sell. All right, so those are the types of signals that we're focusing on. You can see there's a lot of signals that generate, but not all of those signals meet our criteria. Here is a macro pullback signal. This would be one of our high probability signals. All right, so in case you're wondering, with all this going on here, why I'm not looking at taking any of these signals, it's because they don't match any of our high probability signal parameters. All right, so there's crude oil on the Hawk. Take a quick look at crude oil now on the Falcon. And you can see it's kind of the same mess going on. The market's still range bound. The Falcon, what we're interested in is we're interested in this trend line. And you can see right now the trend line looks very much like a roller coaster. We are producing a little bit of a trend change signal here at the moment. The trend line has changed color. We have our up portion, we have our down portion, and the market is coming back with a possible buy signal here. So you can see we've got the warning dots. There's the triangle and hash mark. So what we could do, and can I cover it to there? Oop, don't run away. Oh, there we go. We can still hop in on this one. There we go. So we've got the triangle hash mark. We have one of our higher probability signals. And now we're in this trade and pretty much looking for the market hopefully to rally up here to get up to our break even. You see this assortment of lines that are on here. This is the ultimate support and resistance suite. This is actually an add-on. This will work on any chart, not just DTS. So it doesn't matter if you're trading, a time-based chart or a tick chart or anything really except a point and figure chart. These lines will work for you. And what they do is they show you there's actually 21 support and resistance lines here. And we've got the gold line here in the middle. This is our median line. This pretty much just tells us there's 10 lines above and 10 lines below. It's also kind of like a balance point. So if the market is above here, we're more bullish. If the market's below here, we tend to be more bearish. The blue lines above and below, this is primary resistance, primary support. These three lines tend to be the strongest. So if the market gets beyond here, then we can usually anticipate a little bit of a move. And you can see the median line and the primary resistance have done a pretty good job of containing the market for most of the overnight and most of this morning session as well. Oh, what I should do is I should turn on the stop strategy so you can see how this works. So as I mentioned, we have 16 different, or I may not have mentioned, we have 16 different stop strategies to choose from. Each one is fully customizable. I'm going to try to set the ATR back here a little bit. Yeah, let's go with that. So I'm going to enable my stop, and you're going to see the trade manager pick up my stop from down here and move it to where these blue dots are. So now what's going to happen is if the market continues in our direction, the trade manager will automatically roll my stops for me. So that means I can pretty much ignore this market now. I can go look for other opportunities. And there's more aggressive stop strategies. If you don't like something this conservative, you could go with, say, parabolics, which are going to get the stops right up there nice and close. But we'll see if we can't let this one sort itself out a little bit. We did see a rather quick run up here, and it's not the strongest looking trend change signal because of this. Well, all these highs here, what I would be looking for is, the reason I'm trying to keep my stops so deep is, remember how I mentioned that trading range? We've got the breakout. Well, what happens after the breakout? Well, we get the retest. And I don't know if the retest is going to occur here, or if it's going to try to get down here, or if it's even going to fudge it a little bit. That's why I had my initial stop way down here. But now that the market is broken out, I can anticipate a retest, and if the buyers are serious about supporting this breakout, we should see the market continue from there. But it was a trend change signal, and hey, it's a demo room. It's an opportunity to show you how this software works. But as I mentioned, there are higher probability signals that we tend to focus on. And that's also part of the purpose of the room, is to teach owners those signals. Morris has asked, sorry, I keep calling you Morris. I don't know if it's Morris or Maurice. I have a friend who is Maurice who likes to be called Morris. So forgive me if I'm mispronouncing your name. He's asking, what is your profit target? Good question. We have high probability targets for each of our tools. Oh, and here we had a first micro macro cross develop the same time on our hawk trade. So that would have hit our profit objective. With the hawk scalper, the high probability profit objective is $50 per contract. With the Falcon, it is $100 per contract, as is with the Raptor. And then with the Eagle, it is $200 per contract. Now, with a market like crude oil, because it tends to be more volatile, I will usually double the profit objectives. So that would mean $100 on the Hawk, $200 on the Falcon and Raptor, and $400 on the Eagle. As you probably know, crude oil does tend to make about $1,000 move per day. So if we're on the right side of that, you could potentially take a whole lot more than that out of the market also. Here's crude oil now on the Eagle. And the Eagle, we use this band that runs through here as our directional bias. So right now the band is bullish, with the soft edge is above the hard edge. That's what we call this part down here. And it looks like shortly out of the open this morning, crude oil gave us a hard edge bounce, a red bar buy. So the bars are red, but we got a buy signal off of a hard edge bounce. This is actually a very high probability signal for us. So had we taken it right on the hash mark, oh, you can see we'd be very, oh so close to our profit target. And as I mentioned, the profit targets tend to double when I'm trading crude oil. So we're just floundering here a little bit as the market tries to sort itself out. On the Eagle, I have this tool right here called the Trade Forecaster. This is another one of these add-on tools which will work on any market, on any chart, and it tries to give you the current market environment and then as well as what the next market environment is likely to be. So the current market environment is scalp mode, and hopefully in about 10 minutes time that's going to move into swing mode. And that's confirming really what we've been seeing here on the chart. The hawk made this the most evident. So when the trade forecaster was showing us the markets in scalp mode, well, this is the kind of mess that we were looking at. And they're trying now. You see here the hawk is trying to retrace. We may get that macro pullback signal yet. And last but not least, let's take a look at the Raptor. Now, as I mentioned, the Raptor incorporates elements of all three birds into one tool. So you can see we've got the cloud here from the Eagle, we've got the bar coloring from the Hawk, and we've got the signal generation from the Falcon. The Eagle Trend Trader has also been programmed into the filter down here. And we look for signals that pretty much coming off of the hard edge. Here would be a hard edge bounce signal on the Raptor. We look for things like double pullbacks. We look for cloud crossovers, which indicate trend changes. So here was a nice little cloud crossover. So the cloud crosses over, and well, we got actually an early signal here. We got a later signal here, took some heat on it. Did it work out? Yeah, it was struggling a bit through the overnight. Honestly, I wouldn't have held it that long, but it did eventually get a little bit higher. Usually the cloud crossovers occur a little faster than that. We might be working on a soft edge sell here too, as the Raptor may be trying to get back here to one of the hard edges, but we'll see how that works out. This tool right here is called the Geiger counter. This is the latest indicator warehouse tool. The Geiger counter is pretty much a tape reader. It shows you the history of the time of sales here, so you can see who may be dominant. I really like this dial on the Geiger counter. When the dial's kind of quiet right now, but when it swings over one way or the other and holds, that shows you a lot of buy orders getting chewed up. So you saw there for a moment the dial swung over. There it is. It's holding. It's holding. Oh, didn't hold very long. Now it's holding to the other side. But when you get the dial swing over and hold and hold and hold, that shows you a lot of buy orders getting chewed through or a lot of sell orders getting chewed through. And you can usually anticipate a move one way or the other after that. All right, so crude oil still in their retracement mode. There was another question here from Rob. Rob's asking, okay, he said, you showed the first micro-macro cross to be a high probability trade on the Hawk. What's a high probability trade on the Eagle? The red bar buy, very high probability trade. What we're looking for with the red bar buy or its inverse, the green bar sell, and I'll show you one of those in a moment, is for the market to retrace into the hard edge. And then I'll explain what's happening here is the hollow bars on the Eagle, they're a traditional candle where the market closes above the open. So on this particular bar right here, the market opened here, rallied, and closed up there. So it's a bullish bar. As you can see, the solid body bars are just the opposite, where the market closes below the open. So it tends to be a mildly bearish bar. So here we have the market open, and then it closes, this particular bar closes down here. The eagle also paints the bar colors depending on whether they're more bullish or bearish. So even though this bar has closed lower, the underlying conditions are still bullish. So here we've got the market heading lower. Market conditions are still bullish for the most part, and all of a sudden, they turn red. So market conditions have flipped. The buyers have lost control and the sellers are starting to take control. This is pretty much the last stand for the buyers. If they don't take it away or take it back at this point, you can anticipate that the sellers are going to recapture the market. The cloud will cross over, you'll generate a sell signal, and the market should head lower. But what happens instead with the red bar buy is that the buyers do show up. And you can see you've got this hollow body bar. Another bar later, you produce a buy signal. So you've got a red bar with a green buy signal. High probability signal right there. And normally you don't see them repeat this often, but you can see you had several opportunities here on the eagle. Let me see if I can find you a green bar sell. See, this is how it normally plays out, where you get better progression on the eagle. This has been the last couple of days. Here's a green bar sell. So whenever the market encounters the hard edge on the eagle, we expect it to give us a reaction of some sort. So here the market retraces into the hard edge, and right now I would be looking for a green bar sell, and here we get it. We got the green bars with a sell signal. High probability signal. Another high probability signal on the eagle is the trend change signal. And simply put, it happens when the cloud crosses over. Now it's become more bearish, and it's the first signal that prints, where everything is in sync. So you've got red bars, you've got a bearish band, red signal, red filter. You're usually in pretty good shape to sell. All right, so those are a couple high probability trades for the eagle. And anytime, here's just a regular hard edge bounce that came shortly after the green bar sell. Same thing, you encounter the hard edge, bounces, produces a sell signal. That would also be considered a high probability signal. Each of our tools has about 3 or 4 high probability signals that we tend to focus on. See what I would have done with this Falcon trade. And being in the demo room, I'm allowed certain niceties, let's say. I would have my stop still a little bit deeper, or I would wait for the retest and for the signal to generate now. But we'll see. We'll just let that one ride a little bit, see where it takes us. Another question here from Steve. Steve asks, what is the time frame for the Geiger counter? It's live. It's whenever the market, whenever you get a change in the orders. So it's not based on like 5 minutes or 30 minutes or whatever. It's tick by tick. So whenever somebody buys or sells, the Geiger counter will reflect that. The numbers that you see here just above and below, this is the bid and ask. So the current bid is at 21, the current ask is sitting around 12, 13, 14. But it's how these numbers relate to each other that's important, right? The cool thing about the Geiger counter is, let's say you were looking at, let's say you took this signal here. Let's say you took this hard edge bounce, you generated the signal, you're long from down here. All right, so you've taken some pretty nice profit. Let's say the market's up here and you're wondering, well, what should I do with my stops? Or should I maybe take profit? Well, the Geiger counter, that's actually how the Geiger counter got started. One of the owners said to Adam, I need a tool to help me judge if I should stay in a trade longer or if I should exit or bring in my stops, or what should I do? Well, that was how the Geiger counter originated, because let's say we're in this trade, we've collected a little bit of profit here. I can look to the Geiger counter and I can see how is the market responding, because, hey, we've broken this resistance level right here, right? We don't expect the sellers to just disappear. After all, they've knocked the market down here and here and here and here. So it's to be expected that they're going to maybe give it another poke and try to move the market lower still. Well, if I'm looking at the Geiger counter and my needle is green and it's pulled hard over like this and it's holding and holding and holding, I can usually have a pretty good idea that the market will probably continue its rally, in which case I could run a looser stop, or try to let the market run a little further. I may not take my profit at this point. If, however, the dial pulls over and my needle starts turning red and it just keeps holding here on the sell side, on the red side, I might seriously consider exiting with whatever profit I have, or at the very least, tightening my stops in case there's a major reversal. I obviously don't want to give up all this profit. All right, so that's where the Geiger counter originated from. It's also equally helpful in trying to gauge your entry signal. So let's say you're here and you're producing this hard edge bounce signal and you're debating, should I take this signal? Well, there too, the Geiger counter can be helpful in the same fashion, where if the dial is pulled hard over and everything is green and holding, then it's probably going to have some bullish follow through. If, on the other hand, the dial is pulled over and it's red and the needle starts to turn red and whatnot, it doesn't necessarily mean that you won't take the signal, but maybe you'll dial back your exposure. Maybe instead of taking 2 contracts, you'll take 1 contract. Or maybe you'll look for, maybe you'll choose to pass and just take a secondary signal. Or maybe you'll run a deeper stop, anticipating that the market, if it fills you, may try to come back against you a little bit, and you need to keep your stop out of harm's way. Right? So those are ways that you can use the Geiger counter. Very helpful tool, I find. And pretty cool to watch, too. Good question. Mike is asking, Eric, when do you primarily trade? Do you trade through the evening hours? Sometimes. I do a lot of end-of-day trading when I'm hosting the trading room, because obviously I'm doing this during the morning. Sometimes I'll sneak in my own trade in the trading room also. Occasionally I'll trade the afternoon session if the morning session has seemed lackluster. You can usually anticipate, especially in the stock indices, at least 1 solid move per day. So if you don't get it in the morning, you're likely to see it in the afternoon. Maurice is asking, I'm trading regular and hidden divergence. Do you have signals relating to divergence? Not so much on these tools. These tools have been kind of simplified to make it easy to identify the signals. So something like the red bar buy. The hour that we're going to spend here together this morning, I can probably get everybody proficient enough to recognize a macro pullback signal, which is when here on the hawk, everything stays in sync, but the micro trend line goes out of sync. Right? So everything stays green, the micro trend line turns red, we produce a signal. That's called a macro pullback. High probability signal, by the way. First micro macro cross. First in sync signal when the micro line crosses the macro line, everything's in sync. Green bars, green signal, green trend lines, green filter. Right? Not very difficult to discern. With probably the thing that, as far as divergence goes, the most relative would be the bars themselves. This particular bar style is the mean Renko bars from Indicator Warehouse. The mean Renko bars are a blend of range style bars, like Renko bars, and sorry, I'm trying to do two things at once here. Range style bars and candlestick bars. All right, so those are the mean Renko bars. The nice thing about the mean Renko bars is that they're very good at showing you price action. And as far as divergence goes, we would be looking for, well, shoot, why not? We'll do it right. We'll do it right here. We got a couple. We're looking for something that I refer to as a test of the extreme. Now, these are called different things by different people. The phenomenon is the same. Essentially, we're looking for a retest of the highs and a failure, or a retest of the lows and a failure. These failures tell us that there's a likely reversal coming. Some people refer to these as M and W formations for obvious reasons. Other people refer to them as 1, 2, 3 tops or bottoms. Some people will see these as head and shoulders. Some people will call them cups and saucers, or pardon me, cups and handles. It doesn't really matter what you call them. The principle is the same. Now, the nice thing about the mean Renko bars is that, opposed to, say, a 5-minute chart, or even a tick-based chart for that matter, the mean Renko bars make this price fluctuation very plain, and it makes it a lot easier to spot the divergences early and perhaps take a counter trend signal, or at least get yourself ready for a with trend signal when it develops. Indicator Warehouse does have divergence tools. There are tools in the inventory that are focused on spotting divergences, but not so much with the DTS system. Sammy is asking, do you know how long the trend will last around when we get a buy or sell signal? Yes and no. When all three tools are in sync, the trend has a better chance of being extended than when the market is floundering like this. So, for instance, here, let's take a look at the Eagle Trend Trader. Look at what's going on today in crude oil, right? You can tell it looks very choppy. No big surprise. We're still in scalp mode. And in about 10 minutes time, it looks like we may actually be moving into trend mode, which would be nice. But take a look at what is happening today versus what happened yesterday. Look at the nice smooth progression. So when you get these types of days developing, I can tell you, well, here, I don't have to tell you, I can show you. Let's take a look at what was going on here on the Hawk yesterday. Excuse me while I make you guys dizzy. We'll roll this back. See, same thing. Look, just a nice smooth progression. You get a first micro-macro cross signal, the market goes somewhere. You get a macro pullback signal, the market goes somewhere. Right? Compare that to this. So it's very obvious right now that crude oil is in chop, and it's just going to be difficult trading until it gets outside of this choppiness. Same thing for the Falcon and the Raptor. If I dial back to yesterday's session, here on crude oil, you can see just nice solid signals. Here's a cloud crossover, here's the signal, nice follow through. Right? Here's a soft edge sell. This is one of our high probability signals. Nice follow through right to the hard edge. Here's a hard edge bounce signal. Good follow through. So this is what happens most of the time. Unfortunately today, the market's looking like this. So just looking at it, you can tell, okay, the market's chopping about a bit. Ranges are a little bit difficult. So we need to be prepared for that. I'd be standing aside for a lot of this until we get outside of here. So when the chart looks a little cleaner, you can anticipate better follow-throughs when the chart looks like this. And if you're using the trade forecaster and it says you're in full-on scalp mode, you can anticipate that your follow-through is going to be limited. The choppiness is, the ranges are going to be wider. And in fact, speaking of wider ranges, I may try to roll my stop back here to where it originally was. To see if we can't ride out this retest that we're experiencing. You can see here on our Falcon trade, we're currently sitting on the primary resistance. This is now our retest. I would very much like to see the market rally from here. And I'd be looking for a signal to come out of this retest. Yes, Tony asks a good question here. Tony asked, Eric, at what percentage do you set your break-even trigger? So frequently on the Hawk and the NASDAQ, I get to the break-even point and then the market retraces just enough to stop me out, and then the price goes to where my target was, my profit target was. On the NASDAQ Hawk, I'm set for a profit target of 10 ticks and a break-even of 5. I tend to, if I'm running the auto break-even feature, which you can turn on and off, by the way, folks, I tend to have my break-even at about anywhere from 75 to 80% of my profit target. My logic is, if this isn't a signal, but I'm just going to show it to you anyhow, because Tony was referring to the Hawk. Let's say I'm looking to buy, and we'll just buy in here in a sec. Okay, so my profit objective is 10 ticks. My break-even trigger is at 8. So I figure if the market's going to get 80% of the way to my target and then fail, I may as well take a break-even hit. Now, even at 80%, occasionally the market will hit the break-even trigger, look back just enough to tag my break-even stop, and then reverse again and hit the profit target. So that can happen even with an 80% break-even. But most of the time, if the market gets between 75 and 80% of the way to your profit objective and then fails, I find I'm better off taking a hit at break-even. At halfways there, you're still within the current range of the bar. Right? You're essentially just one bar high. There's lots of room for the market to reach back and try to tap you before going higher. So if you're going to run that kind of break-even stop, I would suggest you make it a little bit wider, right? And I think you'll have a little better success with it. Great questions. Mike's asking, do you have trade room hours in the afternoon? No. In the afternoon, I turned the DTS owners loose, and they can trade on their own. Part of the purpose of the DTS trading room is not only to alert you to what I might consider a promising trade, which I do my best to do, but it's not solely a trade call room. As one DTS owner so eloquently put it, she said, Eric, I appreciate you producing the trade calls, but heaven forbid you get hit by a bus and I don't know how to use my tools. So that was kind of a backhanded compliment, I think. I'm not sure. But the other point of the trade room is to teach you how to use your tools so that you don't need me, because, hey, I take vacations and occasionally I get sick and I'm not able to host the room for one reason or another. Sometimes, well, whatever, there's a power outage even. So part of the DTS room is to teach you how to use your tools, teach you how to identify the higher probability trades, try to show you what I'm looking for, how I see the markets, and also part of it is a trade call room to try to alert you to what I consider to be a solid trade. And we've actually had a pretty good start to the year so far. Steve's asking, he says, I noticed in your trade manager, one of the stop strategies was called the chandelier. Can you explain what that is? Well, the chandelier is a very conservative stop strategy. Actually, if I turn it on, you can see where the chandelier would have my stops. It's very close to where they are right now. But you can see how the chandelier would have managed the market before. And it's a very conservative strategy. It is based on ATR, as is the super trend. The super trend strategy is another one of these that is an ATR derivative. We also have something like a fixed tick stop, just your basic X number of ticks above the high or low. I'm not entirely sure why the programmer included the open and close, but they're there in case, well, I know the close. Some people like to trail off of the closing price. But there you have it. Parabolics, of course. The bar high low is perhaps the most aggressive, or can be one of the most aggressive stop strategies that we offer. Then there's also the swing high low, so you can place your stops above the last swing point. Now notice, even though the stops are down here, the trade manager will not allow me to move my stop further than the initial risk amount. Well, I can, but not, I have to move it manually. It won't roll it automatically. Then we have a whole slew of moving average strategies for you to choose from. And again, they're all customizable. So let's say you wanted to run a 200 moving average stop. Well, that's what that would look like, or even a 100. That's what your stop would look like. Percentage stops. So a percentage of the market range. This one can also be fairly aggressive or fairly conservative, however you choose to make it. And then the ATR stop, good old average true range. So you can plot your stops based on current market volatility. Good question here from Mike. Mike asks, is there a way to customize the software to only alert us to high probability signals? Maybe. There have been a few requests like that of late to Atom, and Adam's been talking to the programmers about it. He's the guy who would make the decision on it, because of course he's the one who would have to pay for it. But if that is something that you would like to see, there's Adam's email address, adam@indicatorwarehouse.com, and he is the one that you could approach about that. Shoot him an email and say, Adam, I would really like the DTS tools to incorporate this feature, and there you go. He'll make it happen. Oh yeah, no wonder crude oil's been so sluggish this morning. It's inventory. I forgot all about that. Thank you, Tony. So Tony's saying, let's get a crude inventory report going here. All right, I'm going to cancel this one out. And what Tony's referring to is a lot of times on inventory day, if the market has made a decent range, what I'll do is I'll use the OCO function and we'll bracket the highs and the lows of the range and just let the market fill us whichever way it's going to break out. Now, today's range, a little bit extended, but we could probably still do it. So we'll throw a buy order above the highs, and the median line here seems to have been holding the market pretty well. So rather than take the low, I'll throw a sell order in below the median line. Now with these OCO orders, you need to remember that they are live the moment you put them on your chart. So I tend to put them away and then pull them in as needed. So we'll start with this. It's still about 10-12 minutes before the inventory report is released. We'll see if the DTS signal doesn't produce a signal before the inventory report. Very often we will get a signal about a few minutes before the inventory report is actually released, and it amazes me how often that signal actually forecasts which way the market's going to go. Now, you don't have to do this merely on the Falcon. You can do it on any of these tools, really. You can do it on the Eagle if you choose, or the Hawk for that matter. You know, we could do an OCO order here. We could sell below this low. We could buy above this high. Make sure we have stops enabled. All right, so there's a possible trade as well. And likewise, you could do it on the Raptor. And you can bracket and you do the same type of trade above and below the. Here on the Raptor, I'm featuring the Trailblazer. The difference between the Trailblazer and the Trade Manager that you see here is this risk component. Now you can put the Trade Manager on the Raptor, and you could put the Trailblazer on the Hawk, Falcon, or Eagle if you choose. The thing with the Trailblazer is it's a one-click system. Again, this came from people requesting things. We had DTS owners who were making some very quick trades, some very active markets, and I think it was Derek actually who was saying, you know, I get the warning dot, I set up for the trade, but I've got to click my stop loss. I can preset my target, but now I have to click to submit the order. And what would happen to him is sometimes the market, if it was a very fast market, which were the markets that he tended to trade, is sometimes the market would move past the signal before he could get to the submit button. So the solution to that was to develop the Trailblazer, which is a one-click system. Now with the Trailblazer, you can preset your quantity, you can preset your targets. So let's say I'm going to trade 2 contracts. On one contract, I'm going to take profit on 20 ticks. The other contract, I'm just going to leave open as a runner, so it's not going to have a profit target. Now, let's say I was looking to buy here, and let's say I'm going to run a, let's run 20 ticks off of the low. Okay, so I've got my stops enabled, and let's say I choose, for whatever reason, I'm going to buy a trend line bounce or whatever. I hit the buy market button, and with one click, I've got my profit target, I've got my break even, I've got my long position, and I have my stops. So that's the beauty of the Trailblazer. The downside with the Trailblazer is because it does not have this built-in risk component that we see on the Trade Manager, this risk component limits your risk exposure to whatever you set, ideally less than 5% of your trading capital. It's a great way to keep from blowing yourself up. So that means if you're trading, say, a $10,000 account, you'll never have more than $200 at risk if your risk is set at 2%. Here with the Trailblazer, you need to know more or less what your position size should be relative to your stops, and then trade accordingly. All right, so there's the Trailblazer. Yeah, David's saying your buy signal on crude oil didn't work. Yeah, that was because even though it was a buy signal, what I would be looking for, and again, you know, as trading a demo room, I'm allowed certain luxuries, but because this was a breakout, I would be looking for the breakout, I'd be looking for the retest, and you see this green bar right here and this bar next to it, the one with the long wick to it. This one is the one that was trying to rally and produce another buy signal for us. If it had rallied, it would have produced what we call a late filter entry signal, which is a very high probability signal, good as money in the bank almost when it prints, but it didn't happen that way. So this wasn't one of our higher probability setups, David. Unfortunately, this morning on crude oil, at least here on the Falcon, we didn't really have anything to show you. I showed you something just to show you how the software works, but if you're looking for a signal, that wasn't the best one. Okay, how are we doing? We've got about 5 minutes, 6 minutes still until inventory, and it looks like the market is hovering more or less right in the middle of our trading range, which is what I like going into inventory report. And the other way you can trade the crude inventory report is to let it break out, and then after about a minute, after all the dust settles, then you can bracket the range. So that's how a friend of mine likes to trade the inventory. Mike makes a comment here. He says, it looks like the Raptor's a little easier on the eyes. Oh, and by the way, you can change these colors. Some people, somebody's always asking, I don't like the blue and I don't like the magenta. Can I change that? Yes, you can change the colors. Mike says, since the Raptor is looking at 3 strategies or birds at the same time, is it more selective as far as choosing higher probability trades? Yes, that is the short answer. The Raptor does sacrifice quantity of trades for quality of trade signals, probably because it filters the signals through all 3 tools. You know, I make a rough comparison of the Raptor is kind of like an electric car, or not an electric car, but a hybrid car where it's half electric, half gas. Is it like a Chevy Volt where it's all electric? No. Is it like a Corvette No. Is it like a Ford pickup truck? No. Does that mean you can't haul stuff, say with your hybrid car? Well, of course you can, but you can't haul as much as a Ford pickup. Does that mean your hybrid car is not necessarily fast? Well, it's fast, but it's not as fast as a Corvette. So, it'll still get you A to B, but it's not as refined as, say, the Hawk Scalper. So see right now here on the Hawk Scalper, we're producing a possible trend change signal. We haven't had a real good test at the extreme, so I'm not getting really excited about it. But we're producing a possible first micro-macro cross, and yet there's no signal producing just yet on the Raptor. Now, to the Raptor's credit, if we had a slightly better setup going into this would have been a soft edge sell, this signal that printed right here. And you could have scalped a couple ticks into the hard edge. I guess each of the tools have their pros and cons. The DTS tools are more specialized. The Raptor tool is perhaps a little bit more general. And I'm not trying to make the Raptor sound like it's less of a tool. It's not. The DTS is like having a Phillips screwdriver, a slot screwdriver, and a Torx screwdriver. And the Raptor is like having the all-in-one screwdriver. I'm struggling for analogies here, but I think you guys get the idea. Yeah, Tony says the trade manager should be in the Hall of Fame, in my opinion. I would second that. This trade manager I cannot overemphasize how important this tool is. If there is one tool that will make or break you as a trader, this is the tool right here. I'll share it while we're waiting. We got another minute before the inventory report. We had a trader come to us who became a DTS owner, and he was always like a onesie-twosie trader. He said for 3 years, he would make a little, he would lose a little, but he never really got any traction. And then he got the DTS system and he got the trade manager. Well, the big deal about the trade manager is it always controls your risk, right? Most traders try to control their risk by keeping their stops really tight. And all that does is it stops you out prematurely, especially on a day like today where we may not get immediate momentum. The market might flounder around a little bit, but eventually get to our profit target. Well, notice the risk amount here is $330. But what if I left a wider stop? What if I put my stop up there? Oh, well, here, let's move it a little further still so I can get it up to 300. There it is. So I've still got $300 at risk, right? The risk amount does not change. It never changes. That's the important part. Anyways, what changes is your position size. So when I had my stops down here, I'm risking $300, but I'm trading 5 contracts. Long story short, this revolutionized his trading. So when he won big. When he lost, he never lost more than he could afford to lose. This is the exact opposite of what most people do. Most people lose big and win small. The trade manager corrects that problem. Now he's not only a full-time trader, but last I spoke to him, he's trading an account he's trading a fund with 500 accounts in it. So that's what a difference the trade manager can make to your trading. Good question here from Mike, and what I should do is put the Geiger counter on here while we're waiting for the inventory report to release. Oh, there we go. So we got a big break to the downside. Where's that Geiger counter? Oh well, on just yet. So we got a big move here to the downside. I'm going to eliminate the break-even trigger. So we fell through the support on the inventory report. Imagine that, we're trading crude oil at $30 a barrel. Who saw that one coming? Oh, well, there was a trend change signal right here just as the report released. So notice how the trade manager is rolling my stops according to my stop strategy. And let's say right now I'm anticipating, we're here at primary support, the market's flinching. I don't want to open that up to a loss. I can hit my break even button and it will force the trade to break even. Or if I'm looking at this and I say, okay, I've got, $250, $300 in open profit, I'll take it. I can hit my close button also. All right, so that's how the OCO function works. That's how the trade manager rolls your stops. We're sitting here on primary support. If we can get below that, we could see a bigger move here still. Mike is asking, is there a reason why you look at the NQ mostly? Do you trade mainly the NASDAQ, and why? Is there any drawback to trading the ES? That would be the E-mini S&P, for those of you unfamiliar with this symbol. The biggest difference between the E-mini and the NASDAQ is the tick value. The NASDAQ and the mini Dow both trade at $5 a tick. The E-mini trades at $12.50 a tick. This means that I can take at least 2 or sometimes 3 contracts for every E-mini contract that I take. Now, what most people don't realize, most people think that the markets move in relative sizes. What I mean to say is they think, well, if the E-mini moves 10 ticks, the NASDAQ's going to move 10 ticks. So if the E-mini is trading at $12.50 a tick, I've made $125 versus $50 in the NASDAQ for those same 10 ticks. But that's not what happens. What happens is they tend to move relative dollar amounts. Therefore, if the E-mini moves $100, the NASDAQ and the mini Dow will also tend to move $100. So if the E-mini moves $100, and I can anticipate that the NASDAQ's also going to move about $100, but if I can trade 2 contracts in the NASDAQ where I can only trade 1 contract in the E-mini, instead of making $100 in the E-mini, I've made $200 in the NASDAQ because of that second contract. The second contract also gives me the flexibility in my trade. Take our crude oil trade, for example. I've got 1 contract in play. We are up $500. What do I do? Do I take profit? Do I try to roll a stop? This is a big deal, right? We're up $600 now. What do I do, Mike? Tell me, what do I do? Right, so if I'm trading the NASDAQ and I have 2 contracts, well, I can quite easily pop out with 1 and leave 1 in as a runner, right? So that's the biggest disadvantage I see with the E-mini, is the lack of trade management. And the E-mini's, or pardon me, the NASDAQ's got plenty of volatility. It's just not as sexy as the E-mini is. All right, what I'm going to do is I'm going to show you now how you can change your stop strategies on the fly. I've gone now to the parabolics to try to protect more of this profit. Parabolics, of course, tend to get very aggressive as the market momentum starts to wane, or perhaps even show signs of reversing. We've broken through the primary support. Next target is here on the secondary support at 30.10. You could even throw in a profit order here. So you could do a buy limit down here and anticipate that as being your profit objective. Typically, if the market has been ranging like this on your support and resistance suite, if we break a zone, we can anticipate the market to move 2 zones. So there's zone 1, here's zone 2. Now, whether they'll get down there before they hit my profit target or not remains to be seen. That was actually a decent breakout. That's the best breakout we've seen in crude oil in some time on inventory report. Notice the width of these bars. This is because I'm using the Indicator Warehouse Dynamic Equivolume Charting. This is an add-on. Also, it will work on any chart, not just the DTS system. It's an easy way to incorporate volume into your trading. So when these bars are getting wider, that tells me there's a whole lot of volume going through on this bar. Why is that important? Well, big volume usually means that the market's going to try to turn. So you'll see at every turning point, the market produced large bars. When the market is trending and there's very little resistance to the market's momentum, the volume is light. These bars are like toothpicks. But when we encounter serious support or resistance, the bars will start to get wider. See here, they tried to turn off of the primary support, got a wide bar, there wasn't any follow through, and then we got these toothpicks going down again, and here their buyers are trying to do it again. They don't want to see $30 a barrel. Oh, way to go, Tony. Tony knocking that out of the park. Bagged 61 ticks on crude oil. That's $610 for those of you who are bad at math. Nicely done. It's a nice way to start the day. Okay, it looks like probably going to get stopped here. They're hesitating a little bit too much. I'm thinking the buyers are digging in a little. This whole level here, as we get closer to 30, around 30.10, very sensitive pricing for crude oil. Let's take a look here. Bernie's asking, what time did the Raptor sell? What time did the Raptor sell signal? So we're looking here at crude oil. We got that cloud crossover signal right here. This all unfolded very quickly, however. This is why going into inventory reports for crude, I tend to bracket the range, because the market, it went boom like this in about a second. You would not have had any time to establish a trade. You had to have your order parked there, waiting. But it too had good follow through. But in hindsight, I can tell you that there was a crossover signal right there. Or if you didn't get that one, you had a secondary crossover signal here. The tools do work, folks. It's like I say, it's partly a matter of learning the tool. So here we are now. Unfortunately, my parabolic stop stopped me out a little bit too early as we get down now here to the 30.10 support area. And prices are struggling with that just a little bit. Look at that. Hit it right on the number. I love it when that happens. Oh, and I forgot about our Eagle trade. So we're currently short here on the Eagle. We're up about $750 on this one so far. I think I'm going to get a little bit more aggressive with my stops on this one. See, the beauty of the Trade Manager also is that it does all this for you, which means a minimum of watching on your part. Give me that 700. I like to see a nice even number. Come on. Oh, that whole 30-10 area is really holding the market up. Come on, give it to me. There it is. We'll take it. I'll take it. No point in being greedy. So I went to the bar high low. My stop was only 2 bars back. I could have made it more aggressive still. I could have gone 1 bar back with a 1 tick offset or a 2 tick offset. But hey, I'll take it. $700 is still fine by me. Especially since this whole 30-10 area seems to be giving us a little bit of grief right now. All right. So a decent little morning in crude oil after having to wait for a little bit. Yeah, Tony says, seems like the crude oil big boys don't want to see $29 oil. No, they're digging in. I think you're right. The closer they get to 30, the harder they're going to buy. It wasn't that long ago that crude oil had a very predictable range between 85 and 105 a barrel. When crude oil got down to 85 a barrel, you would buy. If it got up to 105 a barrel, you would look to sell. That has since gone out the window. Mike asked a good question. How many add-ons can you add to the charts? And can you add other traditional indicators such as moving averages on top of the DTS? Yes. You can add as many add-ons as you like. What I have done is, for the sake of clarity, I have only one add-on per chart. So here on the Hawk, I have the Day Ranger. On the Falcon, I have the support and resistance lines. On the Eagle, I have the trade forecaster, and I have the Geiger counter here on the Raptor. I could have the support and resistance suite on all my charts. I could have the trade forecaster on all my charts. I could have the Day Ranger on all my charts. However, this information is common, so it would display the exact same information. It would be redundant. If I want to know where the support or resistance lines are, I simply glance up here at my Falcon and I can say, oh, 30-10. So if I were looking at, say, a sell signal, well, here on the Hawk, if I'm looking at a sell signal and it's happening at 30-10, I would say, oh, okay, well, I know there's a support line at 30-10. But if you wanted, if you felt better about having them on your chart, then yes, you could put them on your chart, but you're going to see the numbers are going to be all the same. See? Exact same. And that would be true for all the tools. Now, regarding the other part of your question, can you add other indicators? Yes, absolutely you can. I was doing some coaching with a fellow who was really keen on Bollinger Bands, and he had to have them on his chart. And I know Mike Filigera loves fast stochastics. Don't ask me why. Do I even have fast stochastics here? Well, we'll throw regular stochastics on. Oops, sorry. I guess I didn't add that right. Let me try that again. Bollinger's and stochastics. Oh, there they are. Fast stochastics. There you go. So, short answer, yes. You can add as many indicators as you like. My sole criteria for adding other indicators is, does this help you make a decision? If it does help make you a decision, then by all means, use it. If it doesn't help you make a decision, get rid of it because you don't need it. Everything you need is right here. This is all you need to make a decision. This is probably as good a time as any to really highlight the importance of the trade manager. And I'm going to show you a cool little tool here. which some of you will have already seen, so bear with me. Okay, before I get to that tool, just real quick, Rob is asking, what's the difference between the Trade Manager and the Trailblazer? The Trade Manager has this risk component built in, which will limit your risk. So if I get a buy signal, it doesn't matter if I place my stops here, notice the risk amount, or if I place my stops here. Oops. Oh, notice that? It wouldn't allow me to place my stops down here. Trade Manager says, no, sorry, Eric, you can't afford that trade. So what if I place my stops here? Okay, notice the risk amount is exactly the same, but what has changed is the quantity. The number of positions I'm trading has changed. So the Trade Manager never allows me to risk more than I can afford to lose, and I'm going to show you in a moment why that's so darn important. If you're using the Trailblazer, the advantage to the Trailblazer is it's a one-click system. So let's say I've got my stop strategy enabled and everything, and let's say I'm going to buy. I hit the buy button, and automatically I've got my profit target, I've got my entry order, I've got my stop loss, but I need to know more or less in advance how much I can afford to risk here, right? I don't want to end up risking more than the $300, which is what I can afford. It may be more for you, it may be less, but I don't want to overextend myself and end up risking more than I can afford. This particular tool right here, and you guys can play with this tool, it's at Indicator Warehouse. It's called the Money Expert. And there's a couple more questions here, which I'll get to in a moment, but I just want to show you this really quick because this is so important to your trading success. Everybody gets hung up on the signal. Every forum I go to, oh, what signal do you use to do this? And what do you think about using XYZ indicator and this, that, and the other thing? And it's like, people, it's not just about the signal. Yes, you need a good signal, but you also need a way to manage your trade, and you need money management. Those are all the things that the DTS system and the Trailblazer and or Trade Manager will give you. You have a method. You have 16 methods here to manage your position, right? You've got stop strategies to manage your trade. You have a risk component to manage your risk exposure. This is so, so important. All right, so I'll show you how this works. So here's Joe. He's a onesie twosie trader. Well, he's a onesie trader. He's trying to be conservative. He's trying to be smart. So Joe starts with $10,000 and he has a pretty good run. He runs his contract or his account up to about $13,500. Very good. Now, what if you had used position sizing? What if you had let the Trade Manager in and managed your trade? Okay, well, mathematically this works, even though, well, actually, I did meet a fellow who started with $10,000 and his very first trade, he ran it up to $40,000. So maybe this isn't so unrealistic. But if you had used money management and correctly capitalized your position, that same $10,000 could have turned into $60,000. Now, what's happening here is every time Joe wins, you win. Every time Joe loses, you lose. So you see, you had a pretty dramatic drawdown here. Joe would have had a less pronounced drawdown. But here's the important thing. By only risking 2% of your capital, you can have a system that is only right half of the time. That kind of takes a little bit of the wind out of the I got to have the perfect signal scenario, doesn't it? If you're only right half of the time, but you're risking only 2% of your trading capital, okay, well, this is actually a pretty good chart. This is probably very realistic. You and Joe are not that far off. Joe has got the blue line, you're the green line. We're actually a little bit worse off in this case. We started with $10,000. hit a little bit of a skid, hit a few winners, and then had a little bit of a drawdown. But at the end of the day, Joe finishes at about $13,000, and it looks like we're about 12,750, give or take. The point is that with position sizing, we didn't do that much worse than Joe. Okay, now let's see if we can do a little bit better than Joe. No, this one we're pretty much even up. These trades are all randomly generated, by the way, and I'll show you these in a moment. But you can see that, again, this is very realistic. We had a few winners, took a few losers. Looks like we took about 10 losers in a row there. Had a few winners, a few losers, few winners, few losers. So we started with 10. At the end of the 100 trades, we're up to about 11,000. But again, by using position sizing, we didn't suffer any adverse effects versus just being a onesie-twosie trader. Now let's take a look at this. We start with $10,000. We have a few winners. Joe runs his up to a little over 13,000, looks like. We take those same trades and we earn another $2,000. We're up to $15,000. How would you like to have an extra $2,000 kicking around in your account? And for what? For doing nothing more than managing your trade correctly. We'll do it one more time. Same scenario. We're pretty much lockstep with Joe until about 60 trades in, and then we start to break away. So he makes about $16,000. We make about $18,000. Trade for trade. And only being right 50% of the time. Shoot, if you take a tool like the Hawk and you're trading the first micro macro cross, which is right about 80% of the time, you can make some silly money. So Joe goes from $10,000 to about $20,000. You could take that same $10,000 and run it up to about $34,000. And if you think that's not realistic, folks, the math does not lie. And here, let me show you just real quick. You're going to see there's no huge home run trades here. The biggest one is a $500 winner, but there's no $1,000 trades in here. Most of these, and again, these are all randomly generated, but look, here's a $100 winner. You're going to see quite a few of these. Look at this. Here's a $12.50 winner, $112.50, $87 winner. But what happens? Joe wins $87. Well, you've had two contracts in play. You've just made $175. Here, Joe had a great winner, $400. You made $800. So you see, the power of position sizing is what makes all the difference here. Very important concept. And it's what, no word of a lie, this will make or, well, it won't break you as a trader, but it will make you as a trader. It never allows you to risk more than you can afford to lose. And it always makes sure that you are maximizing your earnings. It's quite literally the best of both worlds. All right, we're getting near the top of the hour here. A couple more questions. David is asking, is your trade room open daily? If so, what are the hours? Can you please explain the different auto trade systems, the one you use for trade entry? Okay, the trade room open daily. Yes, it is open from 6:30 to about 8:30. That's Pacific time. So that would be 9:30 to 11:30. Essentially the morning session. And it's open every day. Every Wednesday we open up the trade room to the public. Because there is no trial period on this software, this is a way to show you how the software works, answer some of your questions, that type of thing. Can you please explain the two different auto trade systems? Now, I think you may be referring to the Trade Manager and the Trailblazer. The Trade Manager, the biggest difference between the Trade Manager and the Trailblazer is this risk component. So the Trade Manager never allows me to risk more than I can afford. It always capitalizes my trade correctly. The beauty of this is I don't have to jam in a stop really tight to try to keep my risk small, because my risk amount is going to be the same. So if I'm going to end up risking about $300 on the trade, why would I not give myself a decent stop? Why would I not put the stop out of harm's way? Remember, your stop is only a cost if it gets hit. It's your safety net. It's not there to maintain some sort of risk-reward ratio. It is there to get you out of the market if the market is not doing as expected. So if you're going to get stopped out, you don't want to lose more than you can afford to lose. That's all your stop loss is there for. The Trailblazer, on the other hand, was built for efficiency. It is a one-click system, so you're going to need to know what your average position size should be. So if you know that most times using a 20-tick stop loss, you'll run 2 contracts. If I hit the buy market button here, you can see I automatically get my stops, I get my profit target, I've got my auto break-even trigger working, but I've got 2 contracts in play. Right? So I need to know that this risk amount right here falls within my parameters of an acceptable risk amount. The Trailblazer does not have the risk component built in. That doesn't mean you still can't use that same philosophy. It just means you need to know more or less what your average position size should be. David's asking, which one's the first micro macro cross? The first micro macro cross is here on our Hawk micro scalper, and it's a very high probability signal. Easy to identify. It occurs when the micro line, that's the thin one, crosses the macro line, that's the thick one, and everything is in sync. So this is the first micro macro cross signal right here. So we've got red trend lines, red bars, red signal, red filter. Very high probability trade. So you can see this one worked, this one worked. We got to go back a little ways to get another one here. This one worked. This one worked, but again, this is why you don't want to jam your stop in right here. Right? If your stop's right there, it failed. If your stop is down here, it worked. And again, if your stop is going to be $300, regardless of whether you put it here or here, why would you not keep it a little further away? Right? It's not a loss until your stop gets hit. Here's another first micro macro cross. They're not at all hard to identify. Again, you're just looking for that first signal where everything is in sync. Here's one that failed, in case you think I'm cooking the books. As good as the signal is, it will fail occasionally. Now, this one should have gotten close enough to hit the break-even trigger. Let's see. Let's say I set it up like this. Yeah, you see it got 80% of the way to the target, which is why that's where I have my break-even. Hits the break-even trigger, so ideally we would have got stopped at this one on break-even, but even if we didn't, and let's say we touched nothing else on the trade and we sucked up the $200 loss, it's not the end of the world. Why? Because it is an amount I can afford to lose. I'm trading almost a $20,000 account here. I can afford to take a $200 hit. It's not going to ruin my account. Very, very important concept. If you take nothing else away with you today, that is one thing that you have to know. Mike is asking, is this presentation recorded? Yes, it is. And Adam should be posting the link or emailing you the link. If you don't have it, don't be shy about writing Adam at indicatorwarehouse.com and asking him for the January 13 presentation. All right, you guys, unless there's any more questions, I think we might close up the room for today. David's asking about the flight path. Different David. David's asking, do you use the flight path to find the best probability signals sync between the three birds? Now, the flight path, I won't load it up right now, but the flight path is an add-on tool. It's like a market analyzer. So if you're like me and you follow a lot of different markets, the flight path will analyze what's going on in each of these markets to alert you to what might be the best opportunity at the time. It's a great tool, but honestly, David, I don't use it all that often. Why? Well, because I usually can generate enough signals out of the three markets that I'm watching. Usually I'm watching the NASDAQ, gold, and crude oil. So out of those three, I usually at least have something going on, and I don't have ADHD that bad that I can't sit still for 10 or 15 minutes for a signal to develop. Now, Ray Burke, on the other hand, he likes to be on top of stuff all the time. So, he'll be jumping from one market to the next to analyze and try to pick up different opportunities. So if you want to, be on top of your assortment and see which one's giving you the best opportunity at whatever time, then yeah, the flight path is a great tool. But honestly, I don't use it all that often. The other David's asking, is your room open daily? Yes, it is for the morning session. The trading room is free for DTS owners, and every Wednesday we open the public room and we try to find you a couple trades and show you how the software works. Rich is asking, will you help with installation? That's Ben's department, and yes, you can get help with installation if needed. Mike, oh, well, you're very welcome, Mike. Mike says, thank you, Eric, for sharing your experience in using the DTS and your wisdom in trading. Well, you are most welcome. Rob is asking, for a long trade, when you have a macro touch on the hawk, does the micro line have to be green in addition to the green bars and green macro line? No, that's what makes this the macro pullback signal. The distinguishing feature is that the micro line goes out of sync. Everything else stays in sync, but the micro line goes out of sync. This would not have been a macro pullback signal. Even though it worked out, I would not have taken it because of the yellow bar. Yellow bars show neutrality. Now, in hindsight, you can say, oh yeah, I would have taken it. It worked out fine. But when this is printing real time, at this point, I don't know if this is just a temporary pullback, if I'm going to see a retest of the lows. This yellow bar would put me off. However, when we come back here again, and now I get a macro pullback signal, where everything stays in sync except the micro line, then that's one that's worth taking. And I wouldn't put my stop right here. I would honestly, I'd throw my stop probably down there and a nice little scalp out of that. Here's the macro pullback to the downside, right? Everything stays in sync. The micro line goes out of sync. High probability signal. All right, you guys, thank you very much for your attendance today. And DTS owners, I'll see you in the trading room tomorrow morning. And remember, we'll have another open house next Wednesday. If you choose to drop in, that would be great. Until then, we'll talk to you guys later. Bye for now.